Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about net liquidity. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Now, you've probably heard me talk at length about liquidity for a year or two on my channel. Be that as it may, I'm certainly not the first person to talk about net liquidity. It's been talked about extensively on YouTube, other YouTube channels, and throughout Twitter. If you go to indicators on TradingView and just simply type in net liquidity, you will find plenty of models that people have put together to track net liquidity, or derivatives of it, right? There's plenty of different models that you can go check out. I would encourage you to go do that. You can see a lot of them are listed on here. There's also one of the people I think who was one of the first people to popularize net liquidity is Darius Dale from 42 Macro. Link to his Twitter will be in the description below, so make sure you give him a follow. He's a pretty good macro analyst. Now, with all that said, what I want to do in this video is try to at least construct a version of a net liquidity model. Now, I do not claim that it's going to be the perfect net liquidity model, but it will be a net liquidity model that we can at least learn from and try to understand how it can be used to potentially navigate financial markets. When you think about net liquidity, you first think about central banks and the liquidity, or at least the balance sheet by central banks, right? If the balance sheet is going up quite a bit, then you would assume that liquidity is coming into the system. If it's going down, you would assume that liquidity is leaving the system. And you can see with the Fed, the balance sheet reached approximately 9 trillion back in 2022. It rolled over, found a low here in March when we had the regional banking crisis. The Fed came to the rescue, bailed out these regional banks, and now it's come back down. Okay, now it's in danger here of going below where it was in March. We'll see if that's an event or if it's just a non-event. I don't know, but that it is at least something we'll be looking at over the next couple of weeks because the Fed is continuing QT and rolling off assets from the balance sheet. Net liquidity, though, of course, is more than just the Federal Reserve. I mean, you can look here at the Federal Reserve's balance sheet as a function of time, and I mean, you can see that in general, it just goes up. There are periods where it goes back down, like you can see here in mid 2018 to late 2019 or so. Well, mid 2018 to mid 2019 or so, you can see the balance sheet went down, and then it started to expand again, and then you can see it shot up during the pandemic. And even after this initial move to the upside, it can continue going up really until about 2022, which is interesting, right? It's interesting to track this stuff. And despite all of the QT that the Fed has done, it still really isn't even that far off these highs. I mean, it peaked out at around 9 trillion and now it's at 8.34 trillion. We're just back to where we were in September of 2021. But where we were in September of 2021, was still a 100% increase in where we were back in, March of 2020. So it really just gives you an idea of just how quickly the balance sheet by the Federal Reserve went up. Now, of course, we need to think more about it than just the balance sheet of the Fed. We also need to look at things like the Treasury General Account. If you guys remember the debt ceiling crisis, or at least dramatization, I mean, it normally is just more for show. As the debt ceiling approaches, the Treasury General Account is drained. This essentially adds liquidity into the system. And then once the debt ceiling is resolved and they can refill the Treasury General Account, as you can see, it's gone from the low 40 billions up to about almost 400 billion. This process theoretically drains liquidity from the system, although you could also look at things like the overnight reverse repurchase agreements and see that that's been coming down in a similar manner as I suppose that the Treasury General Account has been going up. Maybe not exactly, but it has somewhat offset it. One of the things we can do, though, to at least approximate what's going on in the United States is to take the balance sheet by the Federal Reserve and subtract out the Treasury General Account and subtract out the reverse repo. Now, that essentially gives us an approximation for the United States. However, that is not in and of itself sufficient in understanding net liquidity. The liquidity of course comes from more than just the United States. There's other central banks that we should consider. Now, we probably would drive ourselves insane if we added on every central bank, but what if we just get a selection of them to provide a general approximation. Okay, so I'm going to show you a couple of them, but just for reference, the central banks that will go into the net liquidity model that we are going to show will be the Federal Reserve, of course, from the United States, Canada, New Zealand, Japan, China, the UK, the ECB, and Australia. So those are the banks that we're going to at least include in this specific net liquidity model. Now, again, there's other net liquidity models that might include more. There's some that might include less, but those are the ones we're going to include in this approximation. Again, this is what the balance sheet looks like by the Fed. But if you go to look at the ECB, it looks a little bit different, right? I mean, you can see that it looks somewhat different. If you were to go look at Japan, it looks completely different. Now, you might look at this just initially and say, whoa, the Fed is at 8.34 trillion, but Japan is at 745 trillion. You have to remember this is in their local currency. Okay, so it's important to convert that currency over to US dollars. Okay, so that would probably help it make a little bit more sense. And in fact, and we could do that, right? If we were just to you could multiply it, right? So you could multiply it by that local currency, just see what it is. But just if you ignore the quantitative aspect and just look at qualitatively what has happened, the Japan started, printing to some degree back in Q3 of 2022. If you remember, the S&P found a low in October. Again, liquidity comes from more than just the United States. If you go look at China, you will see that its balance sheet has been generally expanding, and it also found this low here in Q3 of 2022, and then it shot up. But recently, over the last couple of months, it's actually been coming back down. So at one point back in Q3 of 2022, we can see that there was liquidity coming into the system from outside of the United States. So despite the fact that the United States was still lowering, or at least removing assets from the balance sheet, you can see that banks from the Bank of Japan and the China Central Bank, they were actually expanding their balance sheet. So again, we're going to include the Fed, Canada, New Zealand, Japan, China, the UK, the ECB, the European Central Bank, and Australia. So we're going to include a subset of all the central banks. It's not all of them, admittedly, but I think it's sufficient to provide an approximation. So if we do this, you get something that looks like this. Okay, if you add in all those banks, you subtract out the reverse repo, you subtract out the Treasury General Account, and you also convert all these local currencies from each bank into the US dollar. You get something that looks like this. Now, what's interesting is that for a long time, it looks like the S&P was tracking net liquidity. As net liquidity came down, you can see that so too did the S&P 500. The net liquidity here globally, again, it's not just local, but it's an approximation of the global net liquidity. You can see it found a low here in September, and the S&P, it found this low in September, but then it had a slightly lower low in October. Now, ever since then, the S&P has rallied, and global net liquidity has gone up, but then it started to go back down. So what's interesting is that this low here on net liquidity in December corresponded to this low on the S&P 500. And then this low on net liquidity in March corresponded to this low on the S&P 500. But now there's a divergence. You can see that net liquidity has continued to come down, but the S&P is going up. So you could argue that the jaws are starting to open up. If you don't know what I mean, look at it like this, right? So here we're not overlaying it on the chart. Here we're going to overlay it on the chart. You can see that global net liquidity, or just net liquidity, is not the entire globe, right? It's just an approximation, but net liquidity was it was tracing the S&P 500 pretty well, but now the jaws are starting to open, where the S&P is going up, but liquidity is going down. This is not the first time this has happened, okay? There's been prior times where we've seen similar things, right? So you could zoom out and look at other times in history where the net liquidity model, you could overlay it essentially with where the S&P was, and you know, there's plenty of examples, right? So back over here, you'll see that liquidity was trending up, so too was the S&P 500. But then at some point, liquidity went down while the S&P 500 went up. Now, this process, the jaws opened in May of 2018. In May of 2018 is when the jaws opened. And they did not clamp shut until Q4 of that year. Right? So liquidity went down, was taking out all these prior lows. The S&P rallied, but eventually it came back down to sort of meet where, you know, where the sort of just meet that liquidity model. Again, these are on two different scales here, but it just shows you that there was a divergence in at least the qualitative aspect of net liquidity going down and the S&P going up. And you'll actually see it play out again, right? I mean, over here, the S&P rallied back up, but guess what? It actually came crashing back down during the pandemic. This is an interesting thing, right? I mean, it's one of those things where like the market, the S&P can climb the wall of worry for a long time. You know, it doesn't care necessarily. It doesn't mean that it can't ever take out these prior lows. I mean, you can see that the low from March of 2018 was taken out in December of 2018, and the 2018 low in December was taken out in March of 2020 in the early stages of the election year. So just because the S&P rallies doesn't mean that it can't eventually come back down to sort of meet, you know, overall net liquidity. So I would just look at this and say, look, there is a divergence here. There's a divergence here on the S&P and the net liquidity model. Again, in 2018, the divergence lasted from May until October, and it didn't even converge in October. It took until about December for it to actually converge, but the convergence process did not even really begin until October. And again, the jaws opened starting in about May. This time, you could argue that the jaws opened starting in April, so that means that perhaps the jaws will start to close in September, which is still a few months away. But it's an interesting aspect. Another thing that I think is interesting is if you were to overlay the altcoin market. I've said before, you know, the altcoin market, it gets hit harder than other asset classes, right? So like crypto in general can get hit harder when excess liquidity is removed. But within crypto, Bitcoin is a relatively safer play over the altcoin market. And that was one of the reasons we talked about why the altcoin market would bleed back to Bitcoin. But an interesting thing here to do is to overlay total 3 with net liquidity. It's a really interesting chart, is it not? Because in this example, this low matches, and even now, it matches. Remember, altcoins are higher risk. They need that excess liquidity to do well in a sustained way. They really need that excess liquidity. And you can see here that as liquidity is drained, the altcoin market does not respond in a kind way. It tends to go down if overall liquidity is going down. You can see back over here where liquidity started to go back up, total 3 also started to go back up. But now that liquidity is back to where it was, look at this. I mean, look at where liquidity is today. It's at approximately total net liquidity that we've added up in these banks around 27 trillion. The last time it was at 27 trillion, total 3, the altcoin market, was at the same valuation that it is today, around 330 billion or so. Look, just draw a line across the yellow line here. You can see that total 3 is more or less the same valuation as it was when net liquidity was at this same level back in late 2022. So the issue, of course, is what happens if liquidity just keeps going down. Now, I believe the Fed is going to continue to reduce their balance sheet, as they've said many times. I believe, maybe someone can correct me if I'm wrong, but I believe the ECB is actually going to increase the rate at which they roll off assets from their balance sheet here relatively soon. I remember reading something about that a few months ago. But I don't quote me on that because I'm not 100% sure, but I'm just now remembering that. So that is the reason why I've talked so much about liquidity. And as liquidity gets removed, it acts as a headwind for risk assets in general. But as we know with the S&P, and as we've seen in the past, just because liquidity is being removed does not mean, it certainly does not mean that the jaws can't open up like they have, right? Like they have. The jaws have opened up. The jaws have opened up before as well. You just roll back the clock and you can see times where the jaws open up on net liquidity in the S&P 500. It didn't mean that the S&P didn't eventually come back down, sort of meet the spot that sort of corresponded with that overall liquidity. I mean, if you were to take a line here and just draw, where the net liquidity was back in December 2018, you can see it was at around 20 trillion or so. Go all the way back across. You can see that the S&P was around that same level back in 2017 when the balance sheet was around 20 trillion. It's just that sometimes this stuff can take quarters to play out, right? Months and months and months to play out. The jaws can open up for a long time before they get clamped shut. It's happened more than once. It'll probably happen again in the future, and as you can see, it's happening now. Equities are not as risky as altcoins. Therefore, they can ignore things like this for longer periods of time. They can climb the wall of worry for longer periods of time. Whereas riskier assets like altcoins are unable to climb the wall of worry in the same way. And it's clear as day. To give you an idea here, the total 3, the altcoin market, is down 71% from the all-time high. 71%. The S&P from the all-time high is only down 8 or 9%, around 9%. Gives you an idea of just how much more risk there is in the altcoin market than there is in crypto, okay? And this is why I've said many times before, right? Like having 100% of your net worth in crypto, in my opinion, is not very ideal. It's not a very smart way to go because if that market drops by 50%, it's rough if your whole net worth drops by 50%. So some level of diversification is generally a good idea. Of course, just in my opinion. But I hope that this net liquidity model is useful. Again, I'm not I'm not the person who's created the idea of net liquidity. There's been plenty of people who have come before me and spoken about net liquidity, as I mentioned earlier. Darius Dale is one of them. He's of course not the only one. He might be one of the first ones, but there's also a lot of other people that have spoken about net liquidity as well. A reminder that you can find plenty of net liquidity models if you just go over to TradingView and type in net liquidity, and you will find plenty of them. I would encourage you to go check them all out. I've clicked through a lot of these and they're all quite interesting, so make sure you check those out. And I think we will go ahead and wrap it up there. Hopefully this video is at least somewhat informative as to why I speak about liquidity so much. And if you do disagree with me about, headwinds and whatnot, that's okay. But at least maybe now I've done a better job of explaining what I mean when I talk about liquidity being drained from the system. Again, if you guys like the content, make sure you subscribe, give the video a thumbs up. I'll see you guys next time. Bye.